Tortilla 2022 interim results. The team. Put me here. Or maybe I'll go here actually. Richard Morris is CEO, Andy Naylor CFO. It's going to be an introduction to highlights, and there's a financial review and strategic operational review and Q&A. I actually missed the Q&A, which is a shame. But here's the presentation. So they're quite a brand, Chilanga and May, with a strengthening presence in central London. I think they had 10. Well, I don't know how many sites they had. They had maybe 10 or something like that. So they've had good progress or great progress in the new site rollout, adding 5 stores and 1 delivery kitchen in the half, all outside of a London bar. The delivery kitchen, sorry, bar the London delivery kitchen. Commenced a franchise partnership with Compass Group and added an airport to the SSP franchise. Fantastic performance during summer and travel hubs, and it proves the suitability of busy travel locations. That means there's going to be loads more of those coming soon. They signed a deal and a commercialized partnership with Uber Eats in July. Strong pipeline, and they're exceeding the original target of 45 sites over 5 years. I thought that was incredibly conservative, to be honest. I don't know why they can't do 100 a year, but anyway, they're going to beat 45 in 5 years, which is, just under 10 a year. They launched a new loyalty scheme with more than 200,000 people signed up, and it's actually driven a 29% increase in frequency. Revenues increased 30% to 26 million. Adjusted EBITDA has fallen to 2.5. We'll look a bit more into that a little bit later on. Strong balance sheet, net cash of 3.2, which is up, over 300%, which is great, reflecting a cash generative model and a capital structure to support future growth. So now we're going to dig into financial review. And by the way, I've done other videos on Tortilla, so check out my other videos after this if you're interested to learn more. Revenues increased a lot, 30%, driven by less loss trading because of, the previous time period was lost a little bit from COVID-19. Addition of 6 new stores and continued sales growth of the estate. Profit margins higher at 77%, 360 basis points lower than the H1, mainly due to the change in VAT rates. Admin increased to 31%, 20 million, in line with revenue growth. I think that's a lot, actually, to be honest. So that's like, what was it before? Like, I don't know. I can't do that math, but maybe it was 16, 17 million before or something. And it's gone up. That's huge. I think it'd be good if they can explain that. I don't know how it's not a huge business. To have admin expense of 20 million is pretty high. Anyway, adjusted EBITDA of 2.5 million, which a decrease. Here we go. So it's decreased by 2.4, but 1.8 of that is to do with VAT. So that leaves 600,000 and less government support. So that's a loss of 1.8. So actually it's above. If you take those two, it should be 3.6 million loss. But look, underlying increase of 1.2 million is due to the growth of the estate, right? So that means that if they keep growing at this rate every year, their earnings per share are going to rise roughly 2.4 million a year. So if they have 2.5 million of earnings, is this for the half? I guess for the half. So let's say they have earnings of 5 million. What can we see here? Actually, let's just see. Where's EBITDA? So they had 5 million last time. But if it's going up about 2.5 a year, if previously it was 10 million with all the support, it's basing down at the moment, which means the share price may fall, but in the future, which is always the main thing for investors, right? And you might be watching this in 2023 or 2024 or 2025, and you can let me know if I was correct here. But it looks like earnings are going to go up quite a bit because they're probably going to go up at least, I would say, at least 2.5 million a year. So if it's 5 million in the full year 2022, then it should be 7.5 in 2023. It could easily be 10 the next year, 12.5 the next year. But the store count is going to go up as well. So I actually think that EBITDA is going to go up even more, to be honest. So this is kind of interesting. Stick around in the video later on. I'm going to look at what's been happening to the business outside of this presentation. This presentation was a couple of weeks ago. Actually, I say it was a couple of weeks ago. It was 6 days ago. Revenue. This is a breakdown of revenue. So it is going up. It's gone up, 30% as they mentioned. So look at this. They're doing a bit of franchising. This is great to see. And this is the impact of the Chilango acquisition. It's about 1 million from Chilango, which is not a huge amount, but it's still something. And franchising is good as well. New store openings adds quite a lot, as you can see. Sales like for like, it's going up, which is great. That's what you want to see from a franchise, that the like for like sales is going up. That means that the strength of the brand is still there, and that's going to attract, if they do go down the franchising route, it will attract franchisees. It also gives the brands confidence to expand. Let's go to the next slide. Revenue per sales channel. It looks like in-store is increasing, if you think about it from the lockdown period. But I think, anyway, let's see. People return to stores, same trend as everyone else in the peer group. The loyalty scheme, Tortilla Club, monthly has increased visits by nearly 30%. And actually their revenue's gone up 30%. So it might be due to this Tortilla loyalty scheme, which is good. It's always good to have a database, by the way. They can do offers. They can do other stuff as well. They can email them about new things, like a new decision to go with Uber Eats in addition to delivery, which is good. And you can see that the delivery revenue has gone up. And delivery is a good model for them because they have a kind of production ready assembly nature, which means they can probably, do a lot for delivery. And that's quite an exciting kind of model for them. If it cuts out customer service and people, they've got staff just building orders in a kind of dark kitchen or delivery kitchen or cloud kitchen, however you want to call it, they might be able to roll out quite a lot of orders, because half of it is, asking the customer what you want. When you go, the in-store experience is very much, do you want this? Do you want that? Do you want this? Do you want that? Do you want this? Whereas if it's already done on the app, they can probably build orders quite quickly and deliver. Gross margin and utility costs, there are pressures here. Gross margin is 2% lower because that's protein costs. I imagine meat's going up because of inflation at the time of filming. There was an impact 3 percentage points on EBITDA. Price less than inflation, only 6% this year. It's important to resist making short-term gains through pricing, so as not to undermine the offer. They don't want to raise prices basically because that will have an impact on sales. And they're cheap, but they're not super cheap. And I think they need to keep it at a low cost for, to keep their volume. So utility costs have been heavily impacted. They haven't hedged the market. It's increased 0.5 million compared to the last year, equating to a circa 40% increase in prices despite government support. They're buying at spot level and they're not buying futures or forwards. They're saying that saved them money, but it's very difficult when you buy when you're buying commercially and you don't buy forwards. Maybe the forward market has gone up, but what it's suggesting to me is that if they had bought forwards a year ago or 2 years ago, then they may have saved money. Instead, they're doing a spot, which means they're transacting, at the time. They're kind of buying it at, they're paying as you go, if you like. They're saying they've saved money, but their costs have gone up 40%, so they haven't really saved money. But anyway, there's a positive here. It's a simple setup of stores. There's minimum kit required, so the impact of utility cost increase is comparatively less significant from the group as a whole. And as I mentioned in the previous slides, the profit is going to go up as they expand their store count They've got a pretty strong database. They've got loyalty. That's the main thing. New stores: Edinburgh, Exeter, Windsor, Bath, Chester Oaks, Bournemouth, Portsmouth. Just in the UK at the moment. Actually, that's not true. They're not in the UK. They are in a few other countries, but they're primarily in the UK. So all of these new store openings were profitable in the first month of trading. That's crazy. Great strength outside of London, underpinned by strong value for money. I knew this was going to be the case. I was a customer of Tortilla 5 years or so before investing. They're saying there's a shortened maturation period for Mexican cuisine. As it kind of rolls out, like people will naturally want to see more of it around the country. This is because, you know, people in London will travel and they'll want to see a tortilla. Like when I go up to Birmingham, which is the second city, or I like surfing. So if I want to go surfing in other places around the country, you want to have a tortilla as a meal because it's very healthy and it's very fulfilling and cheap. Oh, whoopsies. What else we got? So they got strong confidence in, you know, spreading across the UK. I really think they could have hundreds of sites, to be honest. It's just moved me a bit. So the average rent percentage of sales pre 2020, it was 10%. And now it's 13%. No, sorry, it went up to 13%, but they're getting contributions from landlords. 21, it was 9%. Chilango sites are 9%. And for the new store openings, it's 8%. So it's going down. And that's probably because of this landlord contribution is still available. So there might be a hit later on, might go back up to some of the other costs. They're saying that there's great conditions for a rollout, which I think is good. They're eager to secure as many favorable units as possible during this period. And they've got an increased rollout target for the financial year to 15 sites a year. They seem to be very conservative folks. So I wouldn't be surprised if it goes up to 20 sites a year next year, and then goes on from there. Who knows? Maybe in 3 or 4 years, it might be 25 or 30 sites a year. They might start franchising more, etc. A recession period is an ideal time for expansion due to less demand for property. And they intend to capitalize on this, signing 10 to 15-year leases. That is a fantastic idea. I think that's a really strong idea, especially with inflation as well. They can lock in rates for that, you know, now, and revenue will go up, etc. And yes, they're controlling their risk there, and that allows them to grow, which is great. Continue to leverage advantage of flexible new site criteria and ability to take former retail units without the need to install expensive extraction. 6 of the openings this year were former retail units. That means as other restaurants and fast food joints close, as in a recession, a company like Tortilla, and in this case Tortilla, can do very well by expanding and buying up those leases. Next slide. The balance sheet. Acquisition of Chilango generated goodwill of 2.6 million. Goodwill is not a good thing. That means they've overpaid. But nevertheless, I think Chilango is a great acquisition because it reduces competition and immediately expands their store count. Let's go through things on the left first. Net cash of 3.2, with debt of 3 million drawn from a total availability of 10 mil. Strong liquidity provides platform for future growth. They're highly cash generative, which enables a self-funded rollout, which is good. A reconciliation of the opening and closing net cash position is as follows: 6.7 opening, 3.2 adjusted cash, 2.5 for the acquisition of Chilango, which actually I think is quite cheap. One-off fees is 0.2. Capital expenditure for new stores is 2 million. That's really damn cheap. That's 400k per store, basically. This is, did they say 6 stores or 5? I think they said 6. So it's less than 400k per store. I don't know what that is, 3.3 or 330k, something like that. That's really cheap, you know, because they're probably not only going to need to refit stores maybe once every, I don't know, 10 years or something. Maintenance capital expenditure, as you can see, is pretty low. Actually, it's actually quite high. Actually, it's 800K. I'm not quite sure what that is. Payment of rent 1.2, closing balance is 3 million. I'm okay with all of that. I mean, remember next year they're not going to have a 2.5 million or 2.7 million, let's say, cost of buying another firm if they don't buy another firm. So their cash is going to be high. They're probably going to generate at least 5 million next year. Sorry, is this for the half? I think this is for the half. So yeah, anyway, so they're very cash generative. Let's look at the right now, on the right hand side. Right of use assets. I'm not really sure what that means. I've not seen that before actually in a balance sheet or anything, but that's a bit unusual. Property, plant and equipment, that's an asset, that's fine. Intangible assets, I guess, is the brands. Inventory's fine, trade receivable was fine. Cash, 6 million. It's a bit of a weird one, right of use assets. Not sure what that is. Look at that a bit later. Stay tuned, guys, because this is all really, really good, and I'll be talking about my thoughts and insights as I go, but also a little bit more towards the ends. Lease liabilities have gone down, trade and other payables have gone up. I'm not too worried about any of this, to be honest. Total liabilities have gone down, loans have gone down dramatically, so they're repaying debt. You know, it looks like they've repaid like 7 million in debt here as well, guys, which is good. Net assets have gone up, which is always good, but obviously if you look at it, it's gone up by about 4 million, which is this basically, this right of use assets. So I'm not sure what they're counting there. I think that's a little bit, I have to look at that later. Next slide. This is the strategic and operational review. Maybe they'll talk about franchising and international in this, I hope. So, several opportunities. They've acquired 8 bricks and mortar locations, and they've retained a delivery-only kitchen. Guys, they do have lines. I have visited lots of these stores. This is a Chilango conversion, actually, which is interesting. And they do get incredibly busy. 5 of the locations converted to Tortilla. So sorry, this is all to do with the Chilango acquisition. I didn't see the title. Sorry, it's a bit early in the UK. It's 5:30 a.m. Anyway, this is sometimes how I squeeze my time in. I have a very busy job working for Meta. Anyway, so 5 have been converted. The remaining 3 will be retained due to proximity to existing Tortilla units, integration progressing in line with expectations. They're commencing a trial of the brand as a virtual concept in some delivery-only kitchens. Now, this is the virtual concept of Chilango. The focus on protein keto boxes, along with a specialism in alternative vegan products. I think that's interesting. So they're using it as a kind of test and learn platform, if you like. Early signs of sales performance are strong, with the majority of the conversions already above pre-conversion levels, which is great. Chilango sites are in great locations with exciting potential to grow these businesses as the recovery of London continues. Geographic strength. Very healthy spread of profits across the UK. I knew this, you know, from the get-go, this is going to be good kind of everywhere, to be honest. EBITDA, London, 95. The rest of the UK is more profitable. 115 per store in, this is the half. Yeah, so basically it's going to be cheaper for them to expand outside of London, which is great. Sales across London sites are circa 98% of pre-COVID levels. Provides great confidence in acquisition of Chilango, scored more favorable rent deals. So it's all going well, actually, which is interesting. And it shows you that you really need to dig into this, because if you don't go into the detail, you would see that earnings have gone down, and despite revenue going up 30%, if you don't dig into the detail, you just don't know the full story. So the full story, I'll summarize a little bit at the end, but to me, it's doing very well. Outside the UK, outside London, they can expand, and you know, rents are going down. They're gonna fix some of the leases, etc. So they've got 100 store target by December, final year 23. So that is a year and 3 months away, roughly, from the time of recording. So they want to increase it to 15 sites per year, take advantage of depressed property, excellent performance outside London, and considerable white space. And they've used a Kaki, which is a leading business consultancy firm, that did a report in the restaurant property analytics space. And they've said that there's potential 200 potential locations for Tortilla. To be honest, I think there's a lot more than that. I don't think I need to be a data and analytics platform to see that they could be a lot bigger than that. I think Domino's has 1,000 restaurants. They're just a takeaway platform. This, I think Tortilla is both takeaway and in-store. And I think Greg's, which is a bakery in the UK, I think has 2,000 stores. So why couldn't Tortilla have 1,000 to 2,000, maybe even 3,000 stores in the UK? I honestly think it could easily be 1,000 stores. But anyway, that's just me. Let's see. They're on track to deliver 11 new stores this year. One of these openings is a delivery kitchen in Maida Vale in London, and has since been closed along with the sites in Brent Cross, which opened last year. This was a condition of a non-exclusive trading relationship on delivery. So that's a little bit confusing. So I guess that's going to reopen, maybe. 5 and H2 are full stores and located in Lincoln, Leicester, Coventry, Durham, and Canterbury. It's interesting because there's a blend of locations there. Some of these are kind of old school and maybe a bit more formal, upper class. Like I think Canterbury was where the Canterbury Tales are. It's very quaint. It's very touristy. It's people have money there. It's interesting. Maybe Durham a little bit as well. Coventry and Leicester are less so. They're more everyday places. Everything's a bit cheaper there. So they can exist in, basically they're showing me they can exist in different markets, anywhere basically. They're a mass brand. Bankside lease has surrendered. The site has not traded since the start of the pandemic and wasn't commercially viable due to the Southwark site only 0.3 miles away. This is really an interesting point because I've invested in Domino's Pizza for years and it did very well. It went up 10 times for me, which was good. And I think Tortilla will probably do the same. But anyway, I'm not a financial advisor. This is a key point about the miles away, because what Domino's Pizza identified at a similar stage to these guys, I think I invested in Domino's Pizza when it had 100 stores in the UK. And they said they were going to get to 300 stores. That was their target. And now they're at over 1,000. And what they talk about in a lot of their presentations is the idea of, 1 minute, hold on. Is the idea, just need to get some water, that a store shouldn't compete with another store that is less than a mile away, or it causes what they call cannibalization of sales, which means that it eats into the sales of the other site and it won't be commercially viable. I wonder if Tortilla are finding the same thing, because that 0.3 is too short a distance. So I wonder if it's the same 1 mile rule. If it is, and they become as popular as Domino's Pizza, as I said a moment ago, they could have 1,000 stores in the UK. Anyway, 3 Chilango Cloud Kitchen closures as planned as part of the acquisition they never intended to trade. Interesting. Already well progressed for at least 12 sites this year. 3 exchanges in London and South East. 1 HOT agreed. I'm not quite sure what that means. Anyway, I guess that's contracts maybe. And 1 agreed in Northern Ireland. That's interesting. Next slide. Value for money. Inflation is above 10% at the moment at the time of recording. And Tortilla is cheap. It's got delivery and in-store sales. Sorry, this is prices compared all store and delivery to all these brands. Tortilla is this one here, and it's the green ones, and you can see they're on the value range, and I know this because I'm a customer. You typically spend between £6 and £10, whereas if you want to go to Wagamama, it's more like 10 to 20. I mean, here it says it's not, but if you buy drinks and whatnot, then it ends up being £15-20, and that's what they're seeing here. Five Guys, Honest Burger. I love a lot of these places, but I think what they're getting at, and I think this is my experience as well, you're more likely to go to a brand like Tortilla more frequently because a burrito is just $6.75. You're probably going to go like 4 or 5 times a month, whereas some of these more expensive ones, like Honest, you might only go for once a month. And there's a survey there with some results. This is a repeat here, so I'm not going to read that. Summer sales were more challenging than expected. It was incredibly warm in the UK, and I don't think burritos sell that well in incredibly warm weather. It would be my assumption. I actually think they probably do well in cold weather. I think, winter and autumn, which is the time I'm recording this, I think they'll do well. I don't know what a CGA is. If anyone knows, let me know. Don't know. Anyway, the like for likes are going up. So it looks like it's going the right direction. And this correlates to what I was saying, that autumn might be a stronger time for them. Frequency as well. This loyalty program, I think, is a great idea. I didn't see Domino's doing that, actually. Don't remember them doing that. I know they do the offers on Tuesdays and things like that. But anyway, so there is a challenging trading environment, but they feel like they're well placed to navigate these headwinds. They've got inflation, cost pressures, but they say that H2 is better for them. Maybe it's weather, I don't know. There's a bit of uncertainty, however, they're mitigating this by buying goods direct from producers, the implementation of technology solutions to drive cost efficiencies, and further pricing. I don't know if that means further pricing increases, which I would recommend not doing for at least 6 to 12 months. But let's see what happens there. I suppose I would still buy burritos if they were $7.50, but I don't know if everyone else would. Obviously, this is time sensitive. In 10 years, inflation will mean that everyone will need to increase prices. Maybe not even 10 years, maybe just a year. Anyway, summary. They remain encouraged because of like for likes and outside of London, great sales, etc. New openings are doing very well. It's value for money. They're cash generative. They're going to be rolling in the cash soon. Key priorities is to mitigate cost headwinds to return profitability back to pre-war. They're talking about COVID as being pre-war, unless this is to do with the war in the Ukraine. I'm not sure. Ramp up new site expansion to 15. I think that can go to 20 easily. And they're reviewing and pursuing European opportunities. I think this is a great idea. Remaining highly confident in achieving the group's exciting long-term growth potential. Q&A, appendix. So it's founded then, blah, blah, blah. So they're talking about franchising, future international. I'd like to see a bit more information about the franchising and international. I don't know if they go into it. There's the team. There's just the offer and some stuff on the news. This is the store formats. I'll move my face so you can see better. Different size formats, etc. They're looking at a 30% minimum investment hurdle, return on capital employed, which I really like to look at this metric, by the way. I think it's the best metric to use. And if they grow at 30%, then this is going to grow. The share price is going to boom. It's typically what happens. I can't tell you it's definitely going to happen. I'm not advising anyone to do anything. I'm not a financial advisor, but when companies can grow their return on capital employed by 30% or more a year, earnings follow and share prices do go up. That's been my experience. And that's exactly what happened with Domino's Pizza. Okay. If you're going to look at a Domino's Pizza share price, you have to also factor in the, when they not dilute the shares. My mind's gone completely blank because it's about 6 a.m. here, 5:45. But anyway, all right, the CPU, they've got a centralized production unit in Tottenham. They do have to spend money on these kinds of things. And this is typical, it's a central location. So I'm not going to read into that too much. This is what a lot of companies do. I got people and blah, blah, blah. I think that's relevant. ECG stuff. I want to have renewable energy, blah, 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 blah. I don't think any of this is really going to impact the stock, to be honest. Shame they didn't talk about, that's a bit of a shame. I'll talk about my opinion now. It's a shame that the company didn't mention too much about their international opportunities and franchising opportunities, because I feel that could be where the growth really steps up. Maybe they want to get to 200 stores in the UK first and then think about international growth. Maybe they want to be earning, a lot of money in the UK first. That would kind of make sense. If the company starts to have earnings and of maybe 10 or 20 million a year and cash, similar levels of cash in the bank, then they can kind of not relax, but they can kind of start to think about franchising international opportunities. Maybe that's what they're doing. I'm glad I went through this deck. If you're watching this in 2022, you might be thinking, this is a small company, and you're right. It is a very small company at the moment, but I'm going to share my screen. Steps, keep with me, and you're going to see what can happen. It's gone down a little bit. Domino's Pizza, 2%. So I invested in Domino's Pizza in about 2007, 8. There's been a few times where they've split the stock. So I invested between about 100p, and it went up like 10x. So I don't know when they split their stock. Really kind of a stock adjusted share price chart, because it's gone up a lot more than this. I don't know if I really wanted to show you, what can happen, because the stock's gone up loads, but they've had some share splits. Sometimes they can, in some of the charts they show you about share splits, but I think Domino's is a similar story to this. But remember, when this is Domino's UK that I'm talking about here, that's a really important thing to recognize. Wonder if they talk about share splits. No, they've just got dividends. Here we go. Is that share split? Here we go. So they had one split in 2007. They had any others? That was it. So it's gone from about they were very small in the year 2000s. It went from kind of $7, up to, or what is it now, 225. But there's been one share split. It's got about 600. That would be so that's about 100x from Domino's Pizza. I got about 10x or something like that. Now, just for those people thinking, well, if your stock went up 10x, why aren't you a multi-millionaire? I wasn't at the time because I was very young. I don't know how old you think I am now, but in 2011, I was much younger than I am now. So anyway, Tortilla, how does this, talk about this? How is it relevant? Sorry, it's relevant because financials can go up quite a lot. It is a shame they don't have more time periods here. Look at this. EBITDA has gone from 83 million. This is Domino's Pizza to 145. That's crazy. I wanted to get a 10-year report, but I can't. Anyway, this can happen with Tortilla as well. Let's go on store count for Domino's, because UK 1,200 now, and I think that's really important to know that the brand's a good franchise, can grow globally. And why can't Tortilla be an international franchise opportunity? I think it could. And as a stock investor, someone that likes to invest in companies, I think Tortilla is a potentially multi-year investment. And I'd be interested to see what happens over the coming years. I honestly think, personally, that we could have 1,000 stores in the UK. I personally think that Tortilla could have, I see it because I know they've got some franchises in Dubai and the Middle East. And when you go to international locations in London, like Stratford or central London, you do see Arab customers. You see customers from all over the world. You know, you see Asian looking customers and Far Eastern looking customers, you know, Chinese, Japanese. I hear the languages. You know, I used to speak Japanese, so I can recognize different languages, and their customer base is incredibly global. So I think 1,000 in the UK, and I wouldn't be surprised if they could get 1,000 in Europe as well. You know, if you think about it, there's a lot of countries in Europe. The Middle East, they can have lots. You know, honestly, I think that in 10 years, I'd be disappointed if they didn't have maybe between 1,000 and 2,000 stores. And then if we spin on another 10 years, so we're talking 20 years from now, that would be 2042. Why couldn't they be in America? Why couldn't they be? I know there's other Mexican brands in America, but they could be in Latam America as well. You know, as in like, you know, Brazil, Argentina, Mexico, you know, all across the world. Why couldn't they? This would work in the Arab states as well. It would work, you know, the Middle East. It would work probably in Eastern Europe and the Russian states. You know, generally in APAC, I think it would work. So how many stores do I think they could have? 5,000, 10,000? I don't know how many Domino's has globally, but this is an enormous opportunity. They have less than 100 stores at the moment. So if they get to 1,000 stores, you know, you'd expect the stock to at least 10x. By that point, of course, the input costs will go down because there will be efficiencies when they get up to that level of scale in terms of buying. What's it called? I can't remember the operational efficiencies. You know, when you're buying things at that magnitude, as they grow, all their costs will decrease. Their purchasing power goes up and that kind of thing. So, you know, if they survive, which it looks like they will, this is going to be a good company. And it could, I think, more than 10x. That's my opinion, potentially. Before I go, I'm going to look at and show you just how depressed the stock market is at the moment. Tortilla share price. It has fallen like a lot of companies. You know, it delivered this update to the market on the 3rd of October. And, you know, you can see it hasn't really done anything. It's fallen. It's gone from, yeah, it floated at about 200 and it's down to 100. It's got, I can't believe this. It's got a market cap of 40 million. Like if you in this video earlier on, I've made it pretty clear that it's very likely to be earning, you know, 5 million a year, and, you know, by next year, and, you know, maybe in 2 years it might be earning 10 million a year. So why is it valued at 40 million? That's just madness, you know. And if it does earn 10 million in EBITDA in 2 years, it should have a 10 to 20x valuation. So that would be 5x right there. It should go up to 200 million. This brand should be worth between 100 and 200 million in 2 years. I'm date stamping it now. You know, I've said this on the 9th of October, admittedly at, you know, 6 a.m. But I honestly believe that this should be valued over 100 million in 2 years' time. As we go into 2024, I'd be very disappointed if it isn't valued at over 100 million. And the bull case, I think it could be valued at 150 or even 200 million. That'd be a 5x return for anyone investing right now. Not a financial advisor, far from it. I'm a guy, just, I'm a marketer that works for WhatsApp and Meta as my day job, but I like investing. And I think that this company is going to do well. I'm going to stop sharing. If you like investing or you're interested in learning more about investing, both on the public side, listed equities like Tortilla, or on the private markets, angel investing, investing in startups, then I have playlists on both. I focus really on restaurant stocks, both listed and private equity and angel investments, also robotics, software as a service, software companies, that kind of thing. That's my specialism. Franchise companies as well, I quite like. So I hope you enjoyed this video. If you do, how you can support the channel is you can invest in the like button. Smash it, make it blue. Helps me to get found in the YouTube algorithm. I kind of have a subtle feeling that I offer quite a lot of value in my videos. Hopefully you agree. And most people don't see my videos because YouTube doesn't show it to anybody, because I don't get enough views or likes, and likes quite correlated to views. So if you like it and comment, I think that more people will see these videos. Also, if you're interested in learning more about Tortilla and the best time to invest, I've given you, it's the lowest time to invest in this company. And I think it's one of the best times to invest in this company. They're on a growth trajectory, and they're able to secure very cheap leases, and the return on capital is high. They're faster profitability for new stores. It's less, it's less than a month basically, or about a month. They're going to do very well. So to be notified about cool companies like this, and of course, if you're watching this in 2023 or 2024, look back at, have I been right? Has this company more than doubled? Has it hit my growth target for 2024 of 200 million? Or in that case, it might have 5x'd. 5x is 500%. So if you put in 10,000, it'd be worth 50,000. Not a financial advisor, of course. It's just my opinion. I just use a bit of logic, that kind of thing. Anyway, how can you support the channel? There'll be links in the description of how you can support the channel. If you want to do anything commercially, you can buy me a coffee. There'll be a link there where you can, I think there's ways to donate £5 or £10 or something like that, $5, $10. If you want to give more, you can, of course. And there are ways to join the community. We have a great and growing base of investors and smart people. Some of them include CEOs of incredible startups, and some of them include investors as well. Join us by subscribing. If you're seeing this on any other channel, I'm going to try and put these videos on other channels soon. Then consider checking out my YouTube. It's just progress is everything. You should be able to find it. And of course, do share this with friends and family. There are lots of sharing platforms: Discord, WhatsApp, which I work for, Telegram, Outlook, Slack, Facebook, etc., etc. Do share it to somebody that needs to hear this, because just because there's a recession, mega recession coming, doesn't mean there aren't opportunities to do well. All right, guys, really hope you like this. Let me know if you've got any comments, queries, questions, stocks you want me to cover, anything you want me to make in the comment section below. I'll include a feedback form that you can fill out. It's just a Google form where you can privately submit comments, and you can also submit any videos you'd like me to make. If you're interested in Tortilla or investing in restaurants or other stocks or robotics or other startups, there'll be other videos that YouTube thinks you should watch next. I recommend watching those. Guys, remember that knowledge is power, of course, especially the right kind of knowledge. And progress is everything. I'll see you guys in the next upcoming video. Take care.